Hello and welcome to the Your Home podcast. We've got an extra special episode today. We're going to be going over what everybody's looking to know about today is the 2024 housing market predictions. What's going to be happening? We're here on the last day of November, going into the last month of 2023. Man, it's gone by fast.
It certainly has gone by fast, but you know what? It's still a great day to be talking about it with you.
We're getting to that time now for us in mortgage where do we need to request the 2021 W-2? The underwriter is still saying, give us the 2021 W-2, and it's crazy. The time flies by so quickly.
Yeah, I mean, 2021 was 2 years ago, which is wild. Because I remember,
it's crazy.
I remember at the end of 2021, we're looking at things, rates were really low. They were actually, I remember at the time that they stayed lower than we even expected. Initially we were thinking they were going to go up sooner or definitely earlier in that year, and they stayed low for the whole year before things started ticking up at the beginning of 2022. But yeah, a lot of time's gone by since.
Yeah, a lot of time has gone by, but it seems to me, and we'll get into this a little bit later, it seems to me that people haven't necessarily caught up. Maybe the time's going by too fast and they haven't necessarily caught up. The market is changing. And, we'll talk a little bit more about this as far as, some of the things that some of the big dogs are predicting are going to happen with inventory and interest rates.
Yeah. So, we definitely took a look at a couple different, articles and, predictions for what the housing market's going to look like next year in 2024. And so, I guess we'll start with rates, right? Where are rates going? So, Realtor.com is expecting rates to be around 6.5 to 6.8% by the end of the year. Definitely in the last couple weeks, in October there, we were definitely around 8%, a little over 8%, and we've certainly seen a bit of a fall back since then. So, a lot of people are thinking maybe we peaked in October and we're kind of on the way down. Obviously, that would be hopeful.
So that is that interest rates by the end of 2024, they'll hold through the end of 2024 at 6.5 to 6.8, or are they saying we're going to have a nice Christmas this year and it's going to drop down to that range? Because we're slightly above that right now.
Right. The Realtor.com article, it was definitely saying by the end of the year we would get there.
So that's in line with higher for longer.
Right.
People saying that we're not going to see.
And it's true. We're not even that far. We're really not even that far off from that point right now. Maybe, kind of depends where you look, but 0.5% or so, maybe a little less. So I think that's definitely something that's pretty feasible. Now, with these predictions, there's really kind of three sort of big factors that kind of could throw all these off or could keep them on track, right? And it's definitely going to be what the Fed does, right? Especially with the rates, right? But the other two factors on it are, next year's an election year, right? Election year is always a big factor on monetary policy, interest rates, so that's going to be something that kind of definitely plays a factor.
Yeah.
And also probably could play a factor as far as where they are at the end of the year because the election will be at the beginning of November, right? And then aside from that, all the geopolitical stuff going on.
That's a big one. That's like a COVID level implications. If we get ourselves mixed up in international conflict, nobody knows what, could happen from there.
Right.
So that's something that you keep your eye on. Hopefully we're not having those discussions.
Yeah. Now, historically, in that one, it's really, whatever happens in that realm is going to happen in that realm, and we'll see where it goes. But, as far as election years go, historically, interest rates are lower in election years. Mm-hmm. They want whoever's running for office, the incumbent, they want people to be happy going to the polls. So I think that, us being at lower rates, but that's the thing, lower but still high, right? But everything helps right now, right? So Yeah, I mean, if we get to 6.8, right, that's better than where we are now. So that's a positive outlook.
So you like 6.8. That was what I wrote down here. Rates going to 6.8, 6.5. Do you like that? Or do you not like that so much?
I don't love it. I don't love it.
Why?
Well, the reason I don't love it is it really kind of brings us to our next point, which is a big issue with the housing market right now, which is inventory. And I don't really think that rates going to that level is going to free up as much inventory.
Okay,
right?
So you don't like it because you don't think it's low enough.
Right.
Okay. So I've got a little bit, of the opposite view of it. These high interest rates and, holding back some of the competition, I say, hey, I'll keep this. I think that it's an advantage for buyers in this market to go out and acquire properties and get some good deals. There aren't as many properties on the market, but for the people who are active buyers and those people who are they're out there, they have to sell, that they're motivated if they're selling in this market. When you have that lower competition, you can go in there and negotiate some really good deals. So
yeah,
and then there's the other side of it where you say, do we get into this volley back and forth with, the rates coming down, then inflation goes back up, and then it's this, back and forth constantly of raising and lowering rates because, the inflation goes and runs away again. So part of me says, I like the higher interest rates because of the opportunities that it presents to the buyers.
Yeah, I mean, I think I don't disagree with anything you just said. I think it really just kind of depends a little bit on your focus of the question as far as who is it good for, right? If you're looking at the overall affordability of housing, and if you're looking at that, then yeah, I mean, it kind of needs to be a little bit lower probably to bring it back to where people kind of want their mortgage payments to be in relation to their income, But yeah, definitely on the other side of the perspective, if you are shopping right now, the higher rates, it does help because, I mean, we saw what happened in 2020 and 2021, right? I mean, interest rates were already lower then. I mean, they were in the 4%, for high threes, mid fours, low fives for five, 6 years pre-pandemic on that, right? So then rates went down to those pandemic levels and demand went nuts. Demand went through the roof, right? And then that created a very, very difficult situation for first-time home buyers or people putting small amounts of money down on purchases. And so, yeah, so when you look at things today, right, okay, rates are high and a lot of buyers have kind of been priced out of the market, but the inventory problem being as low as it is still keeping it competitive. That was the one other thing I kind of read through a few of these articles on predictions is that they still think it's going to be a seller's market in 2024. Now, granted, they were attributing some of that to just
real estate agents.
Well,
they were blaming realtors.
No, they weren't blaming realtors. I mean, they were just kind of saying, oh, that's the amount of inventory out there is going to keep it, still keep it competitive. But really kind of going back to what I was saying, though, on the pre-pandemic thing, I mean, yeah. So if rates, okay, we're at 7% now. If rates do go back to 5%, that's going to bring so many more buyers back into the market. It's going to drive up the house prices even more. So, which a lot of people think that's, kind of crazy or impossible. But logically, if you think about it, I mean, that is what will happen. I mean, the demand is there, the supply is low. If rates go down much more than where they are, it's going to create another buyer frenzy, right? So, it's a kind of a tough situation. I mean, overall, so I guess that kind of just brings us into inventory. I'll just get right into it. So I had a little bit.
Well, before okay, you get into inventory, I guess bringing it back to what I was hinting at when it's like, I think that people are a little bit slow to catch up and the time has flown by. These rates being as high as they are and the affordability for buyers being, as low as it is and buyer sentiment just being like in the trash right now, it hasn't really caught up. I think the the times of, hey, my house is going to continue to go up and up and up in value, and it's a seller's market, I'll be waiting for all of my offers and pick through them, and I'm going to squeeze every dollar out of this house. To me, I look at it and say that's lagging behind what's actually happening in the market right now. Mm-hmm. And so if you're a buyer and you're out talking to your real estate agent or a listing agent that's working with a seller, you may have not caught up to say, hey, the market is different right now. Your presentation may still be, it's, seller's market. You're hearing these things. It's low inventory. You can go out and you can still ask for 10% more on your property. And then, as a buyer's agent, working with buyers, telling them that, hey, it's going to be competitive out there. You're going to have multiple offers. You need to drop your contingencies. You need to bid above asking price. And I don't think that that's going to work for very much longer at this level of home prices and rates. I think it's going to take for, the people and the buyers out there to say, hey, no, we want to get a discount on this property. We don't want to pay 8% and 10% appreciation from last year. We actually want to go back down and we want to pay last year's price if we're getting, an 8% rate. So is that making sense?
Yeah, no, I mean, it does make sense. I'm following you there. Home prices, they're actually, Realtor.com is predicting a bit of a pullback. They're thinking that prices are going to go down 1.7%. So not that much. And the other thing with it too is you have to remember, there really was double-digit appreciation 2 years in a row. 2021 and 2022, it was pretty close to double digit both years. So a 2% pullback or 1.5% pullback, it's really quite negligible. But also too with it, that being said, if that is what happens, it is a very small pullback, and it's also not a substantial enough pullback that's going to impact affordability, right? $500,000 house is now $490, right? Well, if the rates are still where they are, somebody on their monthly payment, they're not going to really feel that too much. But
I just think if you're a buyer right now, you need to make sure that you're working with a good agent that's willing to play the game.
Yeah.
That's willing to go out there and look for opportunities. There was a time where it was really easy. Hey, you have to give your highest and best offer every single time. There's 15 offers on this property. Inventory's low. That was the narrative for everyone going out. Right now, if you're a buyer, you need to make sure that you're working with an agent that says they're willing to go and scrap it out with the listing agent to go and get you a deal. Unless you're money bags. If you've got a ton of cash and you're like, hey, we're emotionally invested in this, we want a house, we've got some significant changes going on in our life, a new baby, we're relocating for work. If you're buying for something like that and maybe you have a little bit of the scent of desperation on you, more so than someone else that's able to go out with the flexibility and say, I'm looking for an opportunity, I'm looking to get a good deal. So if you can pair up with a buyer's agent that says, hey, you want to go in and put in offers that are, some might call lowball, but it's really reasonable for this market. Go in and put in offers at 5-10% below, because that's where you feel the market should be right now. So I think that's important, that you're working with a buyer's agent that's willing to do that, because a lot of...
Yeah, for two years it was the total opposite. For 2 years it was just, hey, this is the offer. Yeah. Right, this is the only way you're going to get the house.
Yeah. It's going to... I said today, it's like, okay, somebody will say, hey, I'm waiting for the rates to go to 5% and for the market to correct. Well, how much are you looking for the market to correct?
Right.
Like 10%. I think it should come down 10%. Well, we've got buyers out there right now putting in offers 10% below market. Let's say, for example, you've got offer 10% below market, the rates are at 7%, and they're getting a seller credit to do a 2-1 buy down. So the market just crashed for them. And they just got and the rates just came down for that buyer.
Yeah, you manipulated what they're looking for or what they're waiting on. Right.
Yeah, it's going to take some action if you're looking and you're you're serious about buying and you believe in the benefits of owning your home and you want to get your first property, you got to be out there looking for opportunities.
Right. And this is the fundamental thing with that too, though, as far as the person waiting on the sidelines looking for that 10% reduction. It's like, yeah, right. If you're looking for that, then you should be looking and be trying to get as close to that as you can in today's market, because I do not see home prices coming down. I don't see how it's possible or how that's really going to happen anytime soon. I mean, like we were just saying, as the rates come down, more buyers are going to enter the market. Supply isn't going to magically appear overnight. And what's going to happen then? Prices are going to go up again. There's going to be another surge in prices if rates go down to 5%, because more buyers are going to enter the market and supply is not going to change that much. Now, supply probably will. So that's actually one of the things with that is something that's a little debatable. What is the threshold on interest rates where it does free up more supply, and how much the lock-in effect is keeping people in their homes? So like right now, like two-thirds of homes, or two-thirds of existing mortgages are under 4%. 90% of mortgages are under 6%. Right. So
do you have the equity figures on that? Because
I don't have the equity figures handy,
because that's the percentage of people with mortgages, but only 40% or only 60 or 40, I'm not sure if I'm flip-flopping those, actually have mortgages.
Right.
I believe it's 40% of people who own homes don't have a mortgage.
Right.
So, now you're talking about 60% of that 60% have rates below 4%.
Right. And so, the lock-in effect, it's the whole idea that, because everybody has these low rates and everybody had just refinanced to low interest rates, okay, hey, I'm not going to put my house on the market because I don't want to go buy something else because I'm going to be taking an 8% or, a 7% rate on that. My housing payment itself is going to go up so much just because of where the rates are now compared to what I have. So that's keeping people in their homes, keeping the inventory on the sidelines, and making people not want to be as active in moving or buying a new house, which there has to be some logic there, right? Because that's 100%, that's definitely a huge factor for a lot of people, right? It's kind of tough to do. Now, granted, there's always people moving for job relocation, family size, downsizing, there's always going to be some movement, but, what is the threshold where, how far do rates have to come down for it to, for that lock-in, that lock-in piece to kind of free up some supply, right? And also, how much would it even free up? But yeah, if rates go down, okay, so some of that lock-in effect starts to delineate, and you get some more supply. But I just don't see where it's enough supply that it's going to be more than the demand. So the guy who's the chief economist for NAR, National Association of Realtors, he thinks that the market could absorb a doubling of the inventory, meaning that you could double the amount of inventory on the market today for sale, and the demand would meet it.
So that means would that mean no decrease in prices?
Well, he didn't exactly.
What does that mean, absorb?
Well, that's how I took it. He didn't. The article I read.
All the houses would sell?
Right. That's when you say the market could handle. The market could absorb a doubling of inventory. That's what I take that to mean. Right.
Okay.
Is that, you could double the inventory and the demand is there to meet it.
Is that just a bunch of boomers trading houses with each other?
I don't know. Like I said, he didn't really dive into it.
That's what you have. You have the quote.
Right. So, but that's what I would take that to mean. Now, the other thing that was kind of interesting. So this guy, his name's Lawrence Yun, I think Lawrence Yun. So he thinks that there will be a 15% increase in home sales next year. And I guess his logic on that is basically that as rates come down a little bit more, right? As rates come down a little bit more, that's going to, I guess maybe bring some more buyers in the market or ease on that lock-in effect. Now, on the flip side, Realtor.com expects that inventory is going to fall by 14.7%. So they're a little bit on the... I think
they got some bad predictions. Not everybody's right on these predictions.
No, of course not everybody's right on these predictions, but it's just a little bit of a kind of opposite outlooks, right?
one saying that transactions will increase by 15%, but inventory will fall. Is that just mortgage transactions, like refinance activity?
No, that was
those
home, that
two
was
things.
home sales. Home sales for the guy or the NAR guy, Lawrence Yun. He was saying 15% increase in home sales. The Realtor.com one was saying they're expecting inventory to fall by 14.7%, but they also.
Pardon me. That doesn't make sense to me.
They don't
how those two things could wind up being
true.
True.
No, I agree. They're definitely at odds with each other.
Yeah.
Definitely. Now, also the NAR guy, Lawrence Yun, he also said that he thinks home prices are going to rise 3 to 4% next year. Which I guess that kind of lines up a little bit if he's thinking, that extra 0.5% in the rate or whatnot, them coming down a little bit more is going to ease the lock-in effect. It would kind of make sense then that he sees prices rising a little bit, but that is at odds with the Realtor.com outlook, because they're expecting it to kind of go things to basically Realtor.com is pretty much expecting the market to be pretty stagnant, right? Yeah. They're seeing a little bit of a pullback on price. They think rates will come down a little bit, and they expect inventory to decline further.
Well, I guess I would agree with them as far as the stagnant, just prices staying level. But I would say I agree with transactions increasing and more inventory coming onto the market.
Yeah.
Without price inflation, or some substantial drop in prices.
Yeah. So the one other thing that I thought was pretty interesting in the Realtor.com these are also, just kind of disclaimer, these are national predictions, right? And so when you talk about national predictions, I find that, it's so different market to market, right? So what's true in one place could very easily not be true somewhere else. And so they broke down all these different predictions for 2024 sales percentage growth compared to 2023, and then 2024 price growth. And it's kind of interesting when you look at it. So, like, for example, they're expecting that in Atlanta or around Atlanta, there's going to be a 15.8% reduction in sales compared to this year. And then they're expecting the price growth to remain stagnant. On the flip side, in Bakersfield, California, they're expecting sales to increase by 13.4%. Right? So there's a couple different markets. The biggest one that really stood out to me is they're saying that sales growth in Charlotte, Concord area, North Carolina is going to decrease by 22.4%, which is pretty crazy. That's a huge change.
Well, it's all relative.
Yeah.
What were those markets looking like in 2023?
I guess
they were on fire.
I guess that's true, actually. Yeah, that was one of the hottest places to be.
Bakersfield had a rough 2023, so they've got nothing to do but go up. And meanwhile, Charlotte, North Carolina, and Atlanta, they were hot for 2023.
Yeah,
I have no idea if that's accurate, but I would guess by looking at the numbers that they probably had a good year in 2023, and they've got some room to.
No, that's actually a really good point. Now that I kind of look at this list again, a lot of the ones that have the biggest changes are some of the places that had some of the biggest growth over the last couple of years. Like the one other one is Austin. Yeah, so they're saying Austin is going to have a decrease in sales growth by 11.7%. And then they're also seeing a decrease in price growth by 12.2%. So that's kind of startling if you're someone who just bought in Austin, but Austin's kind of been going through quite a transformation, and I think home values there had increased a ton in the pandemic. Like they were one of them and Charlotte were, they were two of the kind of hot spots on that for, huge increase in migration and home prices going up.
When you have rates, this is what comes to mind when we start talking about this. When you have an interest rate at historic lows and, prices on the rise, there's a real significant value to that 3% interest rate. And that's why you have people that are saying, I'll pay a premium for the property. And that created a lot of the rise in the prices. When interest rates are as high as they are now for as long as they are right now, I understand the supply and demand dynamics, but the demand is just, it's pretty shot right now. So you've got some onesie, twosie transactions right now, people who still have a lot of money that possibly they, accumulated during that time of really low interest rates, and it's sort of tapering off. Mm-hmm. And this is just the way I see the economics on it will work. And as these rates continue to remain high, you're going to have to see some downward pressure on those prices. Mm-hmm. As a rule in real estate, and as a rule in pretty much anything, but especially in real estate, the rule is you make the money on the buy. Have you heard that before?
No.
Have you never heard this before?
I'm not sure. Elaborate.
You make the money on the buy. You don't make the money if you're flipping a house or if you're investing in whatever these products are. You make the money on the buy. You can only go out and sell the property for what the market will will allow for. But you can go in and you can get a deal. You can find sellers that are in a position where they're wanting to negotiate, and that's where you make your money. That's where your margin comes in, is you make the money on the buy.
Yeah.
So it was very easy when you looked at the value of such a low interest rate to go out and say, hey, I'll pay whatever these people want for this property because I'm getting this thing that I have no control over. I'm getting this 3% rate. I'm getting this gift, that came out of a terrible situation in COVID and the Fed artificially keeping interest rates low. So you would go out and you didn't have to, as a buyer, really put much effort in. You just had to be somebody that had a ton of cash and was able to qualify. Right now is where you go out and you put a little bit of effort in and you really go out and you earn it. You can make some money or acquire a property by putting in that work as a buyer. That means you may not get that first house that you're looking at. You will definitely have to be less emotionally attached to the property, but you can go out and find something that's been on the market for a little bit longer. Go in and put in an offer 10 or 15% lower and get some credits to buy down your interest rate to get that 5% that you've been waiting for. So I guess I'm kind of going back to that, but when people talk about, where prices are expected to be, I think that the mentality of the buyer, the thousands of buyers that are listening to this podcast, they need to know that they got to go out there and fight to get themselves a deal, create that opportunity. And they're talking about certain markets are going to be, up and certain ones are going to be down. In your market as a buyer, you need to go out and get the deal that you're looking for.
Yeah. I mean, yeah. And here's the thing. Even, the one guy with the National Association of Realtors, he's saying he thinks they're going to go up 3 or 4%. Realtor.com saying they're going to go down 1.5%. What's really the difference? I mean, there's a difference there, but the bottom line is no one's predicting housing prices are going to fall through the floor. Right, the crash that's coming, that the person on the sidelines is going to say, oh my gosh, prices finally came down. I bought at the right time. I'm glad I waited. I don't know. I just don't see that happening. There's the naysayers, so to speak, right, or the haters, right? The haters on buying real estate right now, saying you're nuts, right? They're the people that think something catastrophic is going to happen in the housing market and prices are going to fall through the floor. And I don't see that happening. Interest rates coming down, yeah, that'll eventually happen. And buying right now at a higher rate is that's a tough pill to swallow. But it's kind of the price of doing business, because what are you going to do? You're going to wait? You're going to wait for them to come down? And what threshold do you wait for on the rates? You wait till they're at 6.5? You wait till they're at 6? You wait till they're at 5. If you wait until they're at 5, you could be waiting for a long time. And over that time, the prices are going to go up, like we were just saying. I mean, if rates drop 2% tomorrow, there's going to be a bunch more buyers in the market, and it's going to drive up the property values higher.
Yeah.
So you're better off, biting the bullet, getting in the game, looking for a house, taking the higher rate, and then when those rates come down, you go to the lower rate, right? Now, obviously, that's within reason. You have to be able to afford the higher payment that you're getting on. You shouldn't be getting into something you can't afford because, you're crossing your fingers hoping the rates come down later. But, but that's just a better mentality to have than, I don't know, shouting at the sky as to why housing is so affordable and how everyone who's buying a house is crazy because you're jealous.
I guess I'm not arguing against the market crash. I'm just saying you got to make your market crash.
Right. Yeah.
If you want it, go make it happen.
Yeah.
Be the guy. And I really believe that there's a lot of people out there that are just being told they can't do it. And it's not that they can't do it. It's just it's not as easy.
Yeah.
It's not going to be. The market hasn't crashed. The supply is still very low. That doesn't mean you can't go out and get a deal on a property. You absolutely can get a deal on a property. There are going to be certain houses that you look at and say, okay, why has this one been sitting here for so long?
Right.
The amount of equity that people have in their homes is something that you should be taking into consideration. It's an astonishing figure on the amount of equity that they have.
For sure.
What did they do for that equity? They lived in their house. They paid their mortgage, and they refinanced at 2.5%. That's what they did. So it's not a lot of effort that went onto it. So how much are people really holding on to something that they didn't go out and put blood, sweat, and tears into to gaining? Yes, they're proud of it. They've got they've bought this house for $100,000.
All they're proud of
and
is
now
their
it's
decision.
$1 million.
All they're proud of is their decision that they decided to buy at the time that they bought. That's all they're proud of. I mean,
so kick their ass.
Yeah, exactly.
Kick their ass. Go in there, and it's like you're just letting them. It's buyer against seller right now. That's what it is. Go kick the seller's ass.
Yeah.
How much if they're putting that property on the market right now during this time, and that they have a 3% interest rate on it? There's a rule in negotiating. The person who cares the least wins. If you're selling your house right now, you got a reason to be selling it, and you should be swooping in as a buyer. And maybe they're selling it because they're looking and saying, this can't be sustained. We want to get out now with this. We want to cash our equity out now, before things maybe do take a dive, and everybody starts selling, because on the way down, that's
right. That's the way
as properties start to
go that way.
All the houses are going to start coming
that's the
back.
Way it'll go on the other end. Yeah.
And so somebody might say, "Hey, this is my time. I'll go ahead and I'll take my ball and go home."
Yeah.
So that they've got an extra 10% to some of these sellers. It's nothing. They got that in a year. They got that 10% in a year. It's not something that they've built up over the 30 years that they've gone from buying their first house and moving up into another one. They got 10% or 20% or sometimes more than that in the last year or two. They're not holding on to that. You can take that. You can get that from them.
Brings up you
can get that off them.
That brings up a really interesting point as far as what what's going on with the equity, right? All these people, so many people saw these big increases of equity in their homes, and that is the thing when you buy a home and you have a mortgage, the equity figure, right? Oh man, I'm sitting on all this equity. It's a made up amount. It's totally theoretical until you sell.
Yeah.
Right. It's like any other asset, right? Or investment, it's, you're up until you hit the sell button. It's kind of just all fugazi, right? So
it's a wazi, it's a woozy.
It's a wazi, it's a woozy, right? Okay, you're up 30% on the house, but until you sell, that wasn't what you got, right? So it is kind of interesting because there's, right now there's with that kind of lock-in effect of those higher rates. In a normal market or a more normal time, I guess you could say, the answer is you could, if you want to liquidate some of your equity and not sell the property and still live there, right, you could do a cash out refinance. Well, right now, cash out refinance is if you're at a 3% rate, you're going to refinance to pull some of your equity out and take an 8% rate or a 7.5% rate or whatever it would be. that seems crazy, right? So it's not a great product for a lot of people right now, right? So then that leads you into how are people accessing the equity? And then you look at home equity lines of credit, which those have been on the rise volume-wise very substantially for the last 12 months.
A lot of people looking for
that reason, right? But there's these new products coming out there which are kind of a little controversial.
Are they controversial? Does anybody know about them?
I mean, they're. I started actually seeing a couple ads on social media for them, but we're always posting stuff about mortgage, so I feel like I'm just targeted for that, But yeah, so they're called home equity agreements. And so here's the thing with those, it's kind of all, I don't know, the mortgage industry never ceases to amaze me on how it can come out with new creative like loan financing products for any market, right? And so this is kind of a prime example of it. And it's a little like on one side, a part of it makes a lot of sense to me is that's theoretically it sounds good, but
explain what it is.
All right, so like a home equity, there's a couple different types. So I mean, I'm not 100% expert on them, but basically it's a lender you basically give a lender a portion of your equity, right? So let's say you had a $100,000 house and you have a $30,000 mortgage balance against your $100,000 house, right? So you're going to do one of these home equity agreements where I'm going to take out, the lender's going to give me 20% of the equity. So I'm going to get $20,000 in the bank today. And in exchange, they're going to get a percentage of your equity when you sell.
Is it a percentage? And then I guess on some of them, it's a percentage of the equity. The terms are drawn up based on the current equity position at the time that you get that loan. And then some of the other ones are agreements where they're getting a piece of your appreciation and future equity gained, from that point on.
Yeah. And the amount of equity that they're taking is pretty substantial. So like the one I was looking at, it was like you could take out like basically you were getting like 20% of your equity, but they're going to take 40% of it when you sell. Now the catch here, and I didn't bring this up. The big catch here is there's no monthly payments.
Well, yes,
which is a huge thing. There's no monthly payments on it. And so that obviously makes it very attractive, especially in the affordability of today with inflation being high, household expenses being high, and a lot of people have racked up a ton of credit card debt, despite whatever. But so they're attractive agreements to people, but it's this kind of, there's something about it that's just a little just doesn't quite sit right with me, because it's like, you put all this time and effort into making your payments, you're building the equity, and that's the great, wealth builder of the home. And then I'm going through like kind of a tough patch now. I need a little bit of money. I'm going to take one of these home equity agreements and give away, 10 to 20% of my equity. I mean, that's just your future equity. So what is it? They'll give you
20%. They recapture their principal. And then 20%, or it's their principal plus the 40% of the equity.
Right, yeah. It's like a match kind of thing.
Okay.
But the way that I think the report I was reading about these, there was like five or six different companies that are kind of really getting serious with these right now. And they all have kind of different ways that they structure them. So it definitely can vary, because there was definitely another one that I was looking at, and it was based on like the amount of equity was based on like the total amount. It was kind of a ratio of the total amount of appreciation when you sell. So it wasn't necessarily like fixed to a certain percentage kind of thing. But
isn't your buddy that talked to you about it is he like a secondary market guy? Like they were trying to pitch him on, hey, we're gonna get a bunch of these things. And
he was at some conference talking about it, and then he was asking me about it, what I knew about him, and then we were talking. He sent me over this report that he had gotten, and it was kind of talking about them being, these types of programs being a hot new product coming on, and but he's not like a mortgage. He's not a primary guy. He's, more investment finance, background kind of thing. So,
Yeah, I don't know. I mean, it sounds to me like if
it definitely depends on the terms. You know what I mean? It definitely depends on the specifics of the terms as far as if it could be a good deal or not. Most of the terms I looked at, in my mind, though, I was like, I don't think this is a good deal. But you don't have a monthly payment. So, like, when you look at it from that perspective, I mean, that throws everything, compared to any product we would offer, if you're taking the cash out, you're going to have a monthly payment with it. Right. So,
and you're looking at the ads that they're putting on social media, and obviously those are going to be tailored to really make it sound great.
Right.
And, the other product that doesn't have a monthly payment that has very mixed sentiment about would be the reverse mortgage.
Right.
There's some people that think that program is, evil and, nobody, even though what I say is when you look at the actual terms of the reverse mortgage, it's a great program. Great. And there's also no monthly payments. You just pay the taxes and the insurance on it. I think it gets a bad rap because there's some cases where the result of the reverse mortgage is a foreclosure. And, so.
Or kids being angry that, their deceased parents,
that the house that they weren't making any payments on actually has a, mortgage balance on it.
Right.
That's $1 million. And.
Right.
Well, we won't go into the reverse mortgage, but in 2024, we could see the rise of the home equity agreement. So, make sure you're taking a look at the terms and the conditions of those, because I'm sure just like with any other product, there's going to be companies that are out there and they're given really favorable terms on them.
Well,
and there's going to be some that, you should probably shop around and they might not have the best terms.
Right. And the other big piece fundamentally with any mortgage product or any financial product or any loan, right? I'm definitely a believer in it being positive that there's a wide variety of loan options and financial tools out there available to people to utilize, because they're all designed for somebody in some kind of specific circumstance that gives you a benefit. I mean,
that's a great point.
Some people even look at a cash out refinance and they go, that's the worst thing you could ever do. And it's like, well, yeah, it could be. It could be if you shouldn't have done it, right? But I've definitely done cash out refinance for people that have saved their lives, where we've consolidated tons of debt, saved them tons of money on the month, and actually pulled them away from foreclosure. You got to be knowledgeable about what you're doing. You got to do your research, especially if you're looking at a home equity agreement, definitely really look at the numbers on it, because all the numbers I saw, I was like, in theory, I was like, oh, this sounds kind of cool. You don't have a monthly payment. And obviously to do that, they have to make money. So, you're going to give them something, some sort of, percentage of your equity when you sell. But from the couple things I looked at, it looked like that amount of equity you're giving up was a lot.
Yeah.
Was a lot. So, if you're looking at those, beware.
As far as wrapping up the 2024 housing market predictions, towards the end of 2024, we have, obviously it's an election year. One of the things that we see during election years is tax laws. We have the Home Affordability and Veterans Support Act.
Yeah.
That is just what it sounds like. It's meant to make homes more affordable for first-time homebuyers and veterans. And in a year like this, an election year, this is something that I could definitely see a big impact on that inventory. Like when you say, hey, we could actually double absorb a doubling of inventory. Yeah. What our data shows is that we would actually, with the Haves Act, we would have a doubling of the inventory. It'd be about there's about 1 million. I think there's maybe a little bit less than 1 million houses, that are currently on the market. It's right around that million.
Yeah, I think it's just over a million.
That are currently on the market. We've got 25 million non-owner occupied properties that are owned by. A lot of it's the majority of it is mom and pop landlords. But then you've got the corporations that are going in and they're buying up these properties. And the Haves Act gives an opportunity for those companies to sell, if they sell to first-time home buyers, to get that capital gains tax exemption. I like in 2024 the people looking at that as a possibility to release a lot of that inventory.
Yeah. I mean, that would be a great incentive to do that.
5% of those homes, that's 1.25 million homes that come back on the market, we can absorb that.
It's a clear path to that, should definitely incentivize some some stimulation on the supply.
So just to clarify what we're talking about here, the Home Affordability and Veteran Support Act, the HAVES Act, havesact.org. This is a proposal that we've actually created, and we're working with several trade organizations, well, one trade organization in particular right now, to get presented to Congress. The specifics of this is it is a complete capital gains tax exemption to any owner of a non-owner occupied property. So corporations and landlords is complete capital gains tax exemption if that property is sold to a qualified first-time home buyer or veteran. So this is specifically tackling the issue of a lack of inventory and affordability for first-time home buyers and veterans. A lot of when we talk about this real estate data being very hyper local, also what we talk about is we're not specifically addressing certain groups of people when we talk about this data and what the affordability is. But first-time home buyers specifically will benefit, and veterans will benefit from the HAVES Act. So my 2024 housing market prediction, just like what I was saying, where you got to go out there and beat up the seller and negotiate to get a good deal. You got to take control. You got to put yourself in the driver's seat for 2024. I think, as far as advice and my prediction, I believe it was Steve Jobs said, you know how he could predict the future? He would create the future.
I think Steve Jobs. I don't know.
Was that Bill Gates? It was Steve Jobs. It was some
Steve
famous
rich
Steve
Jobs
billionaire.
was the one who said you can only connect the dots looking back, which is kind of different than what you just said. So I'm not sure.
All I'm saying, listen,
what do you
Gerald
say?
Hansen says it. Here's how you predict what the housing market's going to do in 2024. You create the housing market for 2024. That means you visit havesact.org, you sign the petition, you get involved, you share that with everyone that you know, you get them also involved in supporting affordability for veterans and first-time home buyers. So if you want to look at 2024 housing market predictions, stop looking up in the sky, get down in the dirt, start digging. Get dirty, do some work. That's how you're going to predict. You create the future. So that's,
can I get a hell yeah, brother?
That's a hell yeah, brother. So that's if you want to look at the predictions for next year, go out. The prediction is you got to create opportunities. So by supporting the HAVES Act, whether you are somebody who would directly benefit from it, like a veteran or a first-time home buyer, even real estate investors, they're benefiting from this as well. They're getting that capital gains tax exemption if they help out a veteran or first-time home buyer. So if you're in one of those two categories, as on the buyer side or the seller side, obviously support this. If you believe it's a good idea. If you think it's a bad idea, there's an opportunity for you to leave a comment and tell us you think it's stupid and why. But if you're just somebody who wants to see first-time home buyers and veterans building long-term wealth from home ownership.
Hell yeah, brother.
Hell yeah, brother.